I'm going to do a quick training on how to use these gamma exposure levels to inform your trading for the day. And like any other indicator, it's not always exact, but it does help create a bias. And today's a really good example. Um, I say that as somebody who is didn't didn't uh, didn't catch that to start the day, and I should have. I was I was just preoccupied. My brain was preoccupied, and I missed the obvious. But this is what we can use gamma exposure for. So in the morning, we get our new gamma exposure levels, and the one that's really the key. We use this kind of throughout the day as it if it shifts or if it stays the same and price moves away from it, is the absolute gamma level. Okay, and that's this one in blue. Now, it just so happens that absolute gamma to start the day and put support level were the same strike at 7,400. They're not always. Put support can be a completely separate one. It's typically below price, but it's just the largest put volume strike. So it's not always below price. Absolute gamma can be at price. It can be above price. It can be below price. That is just the level at which that has the most open interest of both calls and puts. So that's why sometimes it's the same level as a put support or a call resistance, but other times it can be its own level. But that absolute gamma level is going to act in most cases as a magnet for price. So if price is, and the reason for that is because market makers have to are hedging their positions to stay delta neutral, and they use gamma exposure. As I said before, they use gamma exposure to measure their delta hedging, right? So gamma measures the rate at which delta changes. So it's sort of the speed of the acceleration of delta. And, delta, as we know, as we're way, way, way in the money, is up at like 90 to a full one, which means you're getting, the same amount of movement in that option as there are dollars in the underlying. And then when you're way out of the money, they're way down at like, a 10 delta, right? So at the money is usually, a 50 delta. And when we're talking about gamma ramps up here at the strike, and then, starts to decrease in both directions. Okay. So basically, and it's measured a little bit differently. So an at the money is going to be, 0.05, which means it's going to move, delta is going to move 5 cents for every, dollar move in the underlying, right? That measures delta. So, but then, in descending order, it's descending this direction. Whoops, that should be a 3, right? 0.02. And it's also descending in this direction, right? As you go out of the money and in the money, right? So the most volatile delta movement is happening at that strike price. Okay, so we know that as they're trying to hedge their positions to become delta neutral, a level like this, or even a put support level, is going to act as a magnet, right? Or can act as a magnet, and it moves, right? So like if we come and we're trading around it, there might be another strike because it starts to mitigate that level. there might be another strike that starts to take more priority, which is why we update these twice a day. So we see, has absolute gamma shifted by kind of midday? That 1:30 time frame is when I usually do that. And so today we opened up below absolute gamma, and the smart trade would have been, and like I said, I missed it, so I'm not coming from some sort of higher higher level, or like, oh, I caught this, how come nobody else caught this? I should have, though. We're chopping around and absolute gamma is above us, and the probability that we're going to move up into absolute gamma at some point during the day is high, right? So the trade should have been, okay, we're most likely going to drift up into absolute gamma unless a lot of things start happening and shifts. There's news, or there's kind of a dramatic move in the market, and that starts to shift absolute gamma. So this little 5-minute opening range breakout should have been the play this morning for me. My brain was somewhere else. I was looking at other things. And what could have been a good confluence was look at the Qs. We open up below absolute gamma. So it's a high probability that we're going to start moving towards absolute gamma. Right? And the way you can use this also is if I'm playing an opening range break. So an opening range break, let's say I'm playing a 15-minute opening range break. So that would be here and here. And let's get rid of VWAP so we're not, we don't have too many lines here confusing everything. Right? If that's my opening range, I'll actually draw some real lines just to kind of show you. So if this is the opening range, I'll get rid of right? And of course we broke to the upside because absolute gamma was above us. But if absolute gamma sits here above us and we start to get a breakdown of a 15-minute opening range break, I will most likely not take that, because I think it will probably be a little bit of a fake out, because we have to come up and at some point mitigate that level. Now it might work, right? It might be a full pullback, and then we're going to kind of bounce and whatever. But it is an area at which we are most likely going to see some gravitational pull, right? So you see that as we pulled down below it, it kind of pulled us back to it. If we pulled up above it, and we kind of pulled back to it. Now, if we're in a trend day, that kind of changes, and as more people start buying calls, like if we're in a trend up day, more people start buying calls above, that absolute gamma starts to shift to maybe a 730 strike price or whatever. And that's why those get updated, twice during the day. But that can really, wherever absolute gamma is in relation to price, especially right at the open, and then, as the afternoon starts, can really help kind of define a little bit of direction. And then from there, it's also going to act, once we get to it, we're going to see a reaction from it, right? Whether that's a rollover as we're coming up underneath, or we get, in this case, a quick little bounce coming off that, once we touch it, even though we work down through it. It's just a very key level, just as our call resistance and put support. But in my eyes, absolute gamma is the most important level to watch. The AM adjustment, it comes at about just before the open, at about 9:15. I'm on the West Coast, so I'm always doing West Coast times. Peter, no, they just show up on SPX and SPY, and SPY's mathematically derived from SPX because I think XPX is more important. The Qs, IWM, and all of the Mag 7 stocks. Because those are the key ones for the sniper. And, if you know what you're trading, which one of the indices it sits in, you can, if it's not one of those stocks, you can still get an idea of general direction that the market's going to take in that sector. Zero gamma is essentially the level at which we switch between being in a positive gamma environment and a negative gamma environment. And that means we are currently, you can see by the label up here, we are currently in a negative gamma environment on the SPX. And what that means is dealers and market makers are at net negative gamma. And that's important for us to know because when we're in a negative gamma environment, market makers need to hedge their positions. And getting into exactly why this happens makes my head explode. But just knowing this is what happens is important. When we are in a negative, or dealers are in a negative gamma environment, when the market is moving up to hedge their positions because they have negative gamma exposure, they have to buy in the same direction that the market is heading, right? So if we're moving down, right, they are selling and moving the market and pushing the market in the same direction. It's a little like when we talk about a short squeeze in Nate Bear's in DPL, right? A short squeeze happens because people are short, buying starts happening, so buyers are coming in, and then shorters are having to stop out. And to stop out of a short, you have to buy back the shares. So everything is moving in that upward buy direction, even though people are stopping out, and it just accelerates the move. So when we're in a negative gamma environment, market makers are having to hedge in the direction of price. So like today, you get these more outsized moves, right, in the direction that price is moving. Whereas in a positive gamma environment, you get a much more sustained movement. I'm trying to find a good example, but like, this kind of, right, we're moving up, market makers are selling off. We're moving up, market makers are selling off. It's smoother in both directions when we're in a positive gamma environment versus the larger, more sustained moves in a negative gamma environment. And so zero gamma is just that level in which we flip between the two. And that also is called an HVL, which is a high volatility level. So as we switch, you can imagine if we're coming into a zero gamma level where market makers in bulk, most market makers are switching, right, between now, having to essentially go in the direction of price, and they're having to switch based on what's in their portfolio to having to sell into moves up and buy into moves down. When we get near these levels, there's a lot of volatility, right? So zero gamma is sometimes also called HVL, or a high volatility level. So when you come into these areas, you can get some pretty sharp movements or a lot of chop. So it's important to know where that is. And then within this indicator, we also put in, you can turn on max pain for the day and see where max pain is. I find max pain to not be a very important level anymore. So I turn it off, but it's just fun sometimes if it looks like we're coming into a close, it's just pop it on and be like, oh, yeah, we might close near a max pain level, which means that's probably where we're going to end up closing. Austin, it's both. I would say it's more of an informative level, and just know that if you're starting to get close to it, you could get some volatility, some chop, some up and down. And then these secondary levels, just know, right? I mean, we're talking today about direction, but just know that, if you're playing from one level to the next, those are going to act as a little bit of support or a little bit of resistance, but they're not, in my estimation, gravitational levels. One thing I will say is if let's say you have a call resistance level here and no ancillary levels above it, it's probably going to act as the high end range for the day, right? If all your ancillary levels sit below it, if we came into this level and there's nothing above it, like nothing to pull it up, then this is a great place for a call credit spread, in my opinion. And same on the put support side, right? It's just nothing that has to be hedged above it. So it's probably going to act as that upper resistance. Okay, any questions on kind of how to read that and use it to help inform trading? Price is almost always going to drift back to absolute gamma. Now, within the last 30 minutes of the day, absolute gamma can really start to shift. So, we talk about doing the butterfly trades for a certain level. That doesn't always mean that it's going to stay that way. We're just taking an educated guess. So I know a lot of people are like, I want to trade those butterflies and I want them to be right every time. They're just not going to be right every time. We look at option volume, we look at absolute gamma, we look at price action for the day, general sentiment, and then we say, okay, I think it's worth taking a shot at a certain level. And we're willing to risk the whole thing because it doesn't, it works about, I can actually look it up, 43.6% of the time. But it just has a highly high reward to very low risk. So it's not a high win rate trade, but when it does, it's a good one. 60% of the time, it works every time. All right, does anybody have any more questions on that before I stop that recording? Consider it stopped.